right, Sawadee Krap. Delighted to be here in Bangkok. Great. Kapkum Krap. I'm delighted to be here in Bangkok yet again to present at Sustainable Brands. I'm a speaker at Sustainable Brands in the US as well as Spain, and we have a specialty track called New Metrics of Sustainable Business that I hope you will investigate and join in the future. So that's hashtag New Metrics. I'm Paul Herman from HIP Investor. HIP stands for Human Impact and Profit. And over this next time together, we're going to show you, building on this morning's presentations, how purpose can drive products for people and planet, as well as profit. I'm also the author of this book, The HIP Investor, which is taught to MBAs, including here at Thammasat University, where I have taught social entrepreneurship and impact investing. And it's available around the world as a how-to guide. I wrote it so that my mother could understand it, so it should be very clear how to get human impact and profit together. So how good brands can make profits is our theme. And just before we get started, I'm an investment advisor as well as an investment professional focused on good money. So that is my specialty. And everything we're going to talk here is about the potential for what you can do. So there's 5 keys to good brands making a profit. And this is reinforcing of this morning. First, your purpose, then your products, supporting and enabling your people, being transformative with how you interact with the planet, and then being able to realize profits to make that work. So let's start with purpose. We have a hangover. We have drank too much capitalism in the 20th century, and the financial markets have rewarded profit maximization without understanding how profits are made, which is through people and planet and product. So this Nobel Prize winner, Milton Friedman, this quote is going on 50 years old, and it is time to retire this and focus on the new way to generate impact and profit. So doing good and making money are sometimes thought of as different. Sometimes doing good is thought of as charity or just giving, but it is possible, as you learn over these next 2 days in Bangkok, and as you study all of the case studies in sustainable brands, that you can do both at the same time, do good and make money. And in fact, this is unifying self-interest and group interest. So the self-sufficiency economy combines both of these to help yourself and help society. So a sustainable society or a sufficiency economy society combines both self-interest and group interest. So that's number 1. And so building that into your mission statement of how you will help society at the same time as helping people help themselves is part 1. That can translate into your products. So purposeful products, we just saw that the 7 Ps of marketing now need to be the 9 Ps. We agree. And that Maslow's hierarchy of needs are an actual goal for your product. So what we do at HIP Investor is to rate all types of investments on companies, of NGOs who issue bonds, but also of countries. And so we've built upon the Human Development Index to rate countries on their overall development. And you can see several red and orange areas, as well as light green and green. This is your global market. You can help improve the lives of 7 billion people. And by integrating the Sustainable Development Goals, as we've covered this morning, by integrating the Sustainable Development Goals, you can solve 1 or 2 or 3 or even 16 of these problems. So at the New Metrics of Sustainable Business Conference in Philadelphia in the US just 2 weeks ago today, we heard from examples like BASF and SAP, the technology company, as to how they were doing that. We also took a poll to say, what are your sustainable development goals that you're most passionate about? So something to consider in building this into your own purpose and products. And in this mini poll of 300 leaders at New Metrics, climate action, gender equality, and responsible consumption were the tops. So one of the community members of Sustainable Brands is the science and chemical company BASF. They track their overall revenue by how sustainable it is, whether it's making a substantial sustainability contribution, a basic contribution, or targeting issues. So for BASF, this is the majority of their revenue. They're improving their products and serving customers, and 28% of its revenue by 2020 will be in this accelerator category. So the question for you is, how will you do this in your own company? What level of sustainability will your products achieve? And how can you do that through the people that are part of your company? So now in financial statements, for those of you who are accountants, you may know that as much as we say that people are our most important asset, people on the financial statements, on the balance sheet, are not on the balance sheet as an asset. They're on the income statement as an expense. And so these generally accepted accounting principles are actually holding us back from investing in people and realizing them. And do you want to be an appreciating asset, which if we were on the balance sheet, we would be focused on, or a depreciating asset? So 84% of the stock market value for the US S&P 500 are actually these intangible factors: people, patents, intellectual property, because people make products. People serve customers. And the accounting value of people is not always represented accurately on the financial statements. And this transition from a physical-based economy to an intellectual property-based economy means that the majority of your financial value to shareholders is what's called intangible. So in Asia, there's a leading example of this. Infosys, which is a global technology company with headquarters in India, has actually measured people as an asset and put that as a specific human capital value. So on this chart, the red line is the stock market value. The black line is the human capital value. What is the invested asset value of people? And the green line is what accountants say is what the book value of the company is. And you can see that the black line of human capital value in a people-driven business is a better connection to overall shareholder value. Now, this morning we also heard about Thai consumers and who's voting with their wallet. This is a mini poll, again, from the New Metrics conference. So of sustainability-minded people, of about 300 sustainability-minded professionals, we took a poll 2 weeks ago of them at the Sustainable Brands New Metrics conference. And 94% of them, maybe like you in the audience, said, I'm sustainable in my job, in my work. So hopefully you can all say yes to that today. And in your shopping, they said, even though most of us do it at our work, only about 2/3 said we do it in our shopping. And we saw earlier that Thai consumers said that was about 30%, not 68%, but about 30%. Now, the interesting thing is you invest your money in the future through your portfolio. But even among sustainability-focused professionals, only about 1/3, 31%, did it with their own portfolio or their retirement portfolio, which in the US is called the 401k for the tax law. But about 3/4 of people did it through their voting, of electing politicians and leaders to create a society that they want to live in. So this gap between your job and your shopping and your investing are ways that we can take action. So Kun Dr. Nui introduced, how can we take action together? We can take action by changing how we shop, changing how we invest, and making sure that our work and our voting aligns with our values and principles. Now, when you do this inside a company, when you focus on people as an asset inside a company, several magazines have best companies to work for. So in this case, this is the Fortune magazine Best Companies to Work For list. And from the time period of 1998 when it started to 2016 last year, investing in those best companies to work for can nearly double the market return of just investing in the market. So companies who are investing in their people and respecting their people can actually make more money and do make more money for this time period. And there are actual mutual funds that do this as well. Parnassus is a mutual fund company that invests in companies who are listed on the exchange. And so you can see that since it's basically, for the past several years, investing in companies that invest in their own people and their employees and their stakeholders can outperform, as well as be more resilient. Now, there's a special type of people metric that focuses on how much you pay the leaders of your company. So part of what our firm Hip Investor has done with a nonprofit, As You Sow, at asyousow.org, has been to focus on overpaid CEOs over the past 3 years. The 4th year report will be out in 2018. And what we found was CEOs who are overpaid are not delivering extraordinary performance to deserve that overpayment. And after they're overpaid, on the right-hand chart, they actually lag the market or even lose money. And the 10 most overpaid companies of the S&P 500, instead of earning 5% per year for shareholders, they destroy 5% per year for shareholders, a gap of 10 percentage points. So we've been focused on this issue for the past 12 years. This is a leading indicator of destabilizing a company when the CEO is paid too much relative to return. Now, this is one of my favorite charts because my dedication of the Hip Investor book is dedicated to all the strong women of the world and the high-esteemed men who respect them. Over the past 10 years, Credit Suisse has analyzed how companies with more women on the board, starting with 1, so not 0 women on the board, 1 or more women on the board, outperform financially on profit and shareholder value. So this is something to analyze in your own company, because half of the population is women. Your workforce may be more than half women. Your customers may be more than half women. But what is your board? And your board, it should not only be representative of your investors, they should be representative of society. So lining up your board with your executive team and your employees and your supply chain, as well as with society. Or, to make this an easier question, could you explain to your mother why there are no women on your board? So that's the people component. So investing in people can be profitable. Some people think that it costs more to pay people more, but remember, this is about return on investment. Invest in people, and you may be able to realize a higher return. So planet is the 4th component. And the interesting thing here is we have a price for many things in our society, but we don't have a price for clean air. We don't have a price for clean water. When I go kayaking in the mangroves of Thailand, it is not always the cleanest. When I go to the beach in Phuket, it is not always easy to go in the water for a long time. So one of the ways that we can keep our focus on a cleaner planet for air we can breathe is that pricing natural resources and not making them invisible can be helpful. This is really the distinction between running an extractive business or an innovative business. I'll back up since you wanted to take photos. Extractive versus innovative. For any decision in your business that you feel is you have a concern about, ask the group, do we want to be extractive or do we want to be innovative? So Puma is a shoe company like Nike or Adidas, and they, about 5 years ago, created the environmental profit and loss statement to put a price on natural resources, to put a price on air pollution, on greenhouse gas emissions, on land use, on waste, on water consumption and water pollution. And by doing this and applying a financial price to natural resources, They then translated that into what is the value to their business. And they did that at multiple tiers in the supply chain. They're tier 1, tier 2, tier 3, and tier 4 of their supply chain. So if you were to analyze your business and your organization like this, you may see that, like Puma, the land use and carbon emissions and water use of growing the cotton for your shoes, of the cotton for the laces that hold them together, of producing the adhesives, which may be chemical-based adhesives, or like Nike, maybe water-based adhesives. And that when you do that, what Puma has achieved is a increasing efficiency of environmental profit and loss, reduced environmental cost per revenue dollar. So they've been able to grow revenue and grow it more environmentally efficiently. Puma is a private company owned by a larger private company in France called Kering, K-E-R-I-N-G. And so if you look up Kering, you can find these slides along with Puma's environmental profit and loss. And Kering now, based on Puma's leadership, is spreading it through the company. So many of you work for companies that are private versus public. Private companies like to continue for generations, so this is something that you can apply in a tangible way inside your company. So we've covered purpose and products and people and planet. And we've given you a preview of how that translates into profit. So is it really possible? So this is the 12th year for HIP Investor. I can tell you yes, it can be more profitable, and you can invest, if your company invests and you personally invest your portfolio in a sustainable way, it is possible to be more profitable at lower risk. So this is even proven by academics. There are more than 2,000 academic studies. This one is from Harvard Business School, so it has to be right. And so what they found was high sustainability companies outperform low sustainability companies by anywhere from 25 to 40% as a portfolio. Outperformed by 25 to 40%. And so this is over multiple business cycles based on companies who are doing well in people and planet and products and purpose. Then they updated the study in 2016, again over a 20-year time frame, to show that companies who focus on the most important impact, sustainability, and environmental social governance issues, and don't focus on the less important ones, can make almost 6% more per year. So that means instead of making 10% per year, you could make 16% per year. So very compelling. That's also from Harvard Business School. Then Morningstar, which is a financial ratings company, now is starting to apply sustainability ratings, just as we've done for 12 years. Morningstar is now doing for 2 years. And you can see that higher financial performance is possible from funds that are focused on companies that are more sustainable, like SDG, which is on the Dow Jones Sustainability Index. So it's possible to bundle all this together into one overall rating to make this quantitative and to compare it to financials. And so what we have found in taking Maslow's hierarchy of needs and translating this into an impact rating, a 0 to 100 impact rating on purpose and product and people and planet, is that higher sustainable, impactful companies are also stronger financially and lower risk. And that when we analyze 6,000 companies over the past 5 years of total shareholder return, and we've done this over 10 years, we've done this over shorter time frames, we've looked at it from a profit and return on equity, we've looked at it from return on invested capital, that higher sustainability companies, just like the Harvard shows, we have shown as well, can earn higher shareholder returns, and companies that are extractive or lagging in sustainability risk losing money. So this can be the one slide that you show to your leaders of your enterprise to help prove the point that sustainable brands can be profitable brands over the long term. And that by intersecting sustainability and impact with lower risk and risk management, sometimes that's an easier conversation to have. We're going to reduce risk, as well as pursue stronger returns from higher growth markets by solving sustainable development goals. So it's really about future risk and upside. This is a conversation that boardrooms and executive suites and managers should focus on. Being extractive causes you higher future risk. Being innovative lowers your future risk and creates additional upside. So we know these new metrics, and you can research these on the sustainablebrands.com website. You can see presentations like today and from the past 11 years, both from Bangkok and around the world, and they can create sustainable profits. So I encourage you to do that in your own work, do it in your own shopping, do it in your investing, and most importantly, do it in your work to bring it to customers, employees, suppliers, the environment, and society. So I will close here, but I'll be here the next 2 days, and Kap Kum Kap.